The Fed raised rates yesterday 50 basis points in an attempt to reduce inflation and stabilize prices. And I know you're wondering, forget about price stabilization, when are prices coming down? So far, they haven't been. Now, you are having people leave the market since the first rate hike that happened in March. That was 25 basis points or 1/4%. Now he doubled that and they raised rates 0.5%. And he's also signaling that he's going to do the same 0.5% in June and July. Let's see exactly what Fed Chair Powell said about mortgage rates.
Inflation of that unpleasant high nature doesn't get entrenched in the economy. That's what we're here for. One of the main things we're here for, perhaps the most fundamental thing we're here for. And the way we do that is we try to get supply and demand back in sync with each other, back in balance, so that the economy is under less stress and inflation will go down. Now, the process of getting there involves higher rates, so higher mortgage rates, higher borrowing rates, and things like that. So it's not going to be pleasant either. But in the end, everyone is better off. Everyone, particularly people on fixed incomes and at the lower part of the income distribution, are better off with stable prices. And so we need to do everything we can to restore stable prices. We'll do it as quickly and effectively as we can. We think we have a good chance to do it without significant increase in unemployment or really sharp slowdown. But ultimately, we think about the medium and longer term, and everyone will be better off if we can get this job done. The sooner the better.
In that clip, he said a few things of note. That he is attempting to stabilize prices, not really lower prices. Now, in some markets, you are seeing some price reductions, possibly because they were listed too high in the first place. Now, prices are coming down, but are they coming down drastically? And in that middle of the market, I say the middle class, homes, are they coming down? Not yet. So you're probably going to have to wait much longer to see if there's going to be any decrease in pricing, and is that decrease going to be enough to make up for the higher interest rates? I'm going to give you 3 things I think you should be doing now that we know that interest rates are going to continue to rise. I want you to be really, really concerned about your personal economy, your employment position, your savings, your investments, your money, and your budget. Because a lot of people, at least 50% or so of economists that were polled on CNBC, thought that we would be in a recession by 2023, meaning the cost of goods would be so much, or the cost of buying things would be so much that, based on interest rates increasing, that fewer and fewer people will, want to buy goods. We're not at that point yet. The Fed has indicated 2 reasons why they think we're still in a very strong economy. Number 1 is that the job outlook. So there are 2 job vacancies for every 1 unemployed person. So they're saying that, because the economy is really strong, people have jobs. And they're also saying that people are still spending money. So far, Americans haven't pulled back on spending that much. And that could be that you still have a lot of stimulus, maybe you have tax refunds at this point, but so far the increasing of the interest rates hasn't significantly stopped jobs from hiring, and it also has not significantly stopped Americans from spending. But you do need to be very mindful of your own economy. Make sure you have enough savings in place. And I'm not saying that you should have all your money in the bank. You should have your money in investments as well. But you need to have at least 3 to 6 months of savings if perhaps you do lose your job or if there is an economic downturn. So I'm going to tell you 3 things that you need to do with these interest rate hikes if you want to be a first-time home buyer. Number 1, you need to determine if you're underemployed. A lot of people are leaving their jobs in this great resignation. You need to find out, could you be getting paid more for your skills somewhere else? Do not get comfortable where you are when you could be making potentially more somewhere else. You need to investigate that. Do you need to get some more training to get paid more? Or do you just need to change companies, maybe make a lateral move at a company that pays you more for the same type of work? You need to make sure in this economy that you're definitely getting paid what you're worth. There are a lot of employers looking for employees, and you want to make sure you're a valuable asset. Make sure that you're not being, paid less than what your skills and your training are worth in the marketplace. But you have to investigate that to see what are other people paying. Let me put my resume back out there, get on some of these, job websites, network around, and find out, could you be making more somewhere else? Number 2, make it a priority to get a job that is remote or at least flexible. That's going to help you with the price of home ownership. Because if you have a service job or a job that cannot be done remote, then you're going to be fixated more on a particular location for that employment. So if you find a job where you can do remotely, then you can go to places that have a lower cost of living. It doesn't have to be another state, but it could be another city in your state. It could be further away from the major, the main city, but you want to find a job that has some flexibility. If it's not fully remote, do you have to go into work maybe only 2 days a week versus 5 days a week? So that commute wouldn't be that taxing on you, but you want to see, is the position that I have or the position that I can potentially get, can it be remote or can it be flexible? And prioritize jobs that will allow you to do that. I mean, it may make sense to even get paid a little bit less that's remote, and then you can, go to a lower cost area. Number 3, you need to make sure you have a personal budget cap on your housing. And this is if you're renting or if you're planning on buying. Just because interest rates are increasing, that doesn't mean your budget needs to increase. For example, on the very conservative side, Dave Ramsey says don't spend more than 25% of your take-home pay on a mortgage. And on the less conservative side, maybe 35% of your take-home pay. So if we go between 25% and 35% of your take-home pay, that's your personal budget cap. Wherever you're comfortable with, staying in between that 25 to 35%. And that's going to determine what you're comfortable with paying for your mortgage, because that leaves some room. If you have debt that you still need to pay off, it leaves room for investing. It leaves room for other things, so you're not house poor. You need to have know what your personal budget cap is. I have a video about how much your mortgage payment should be. You should watch that next. And just be fully prepared, because there's a 50-50 chance that we may be in a recession in 2023. Now, the Fed is not going to say that. They said that, we're not close to recession because of the reasons that I outlined, because of the job market and people are still spending money. However, if they were to say that, they know how that would impact the market. So just be smart about your own personal economy and make sure you're making smart decisions all around. Thank you so much for watching. Please like and subscribe to my channel for new videos every week.